Have you ever wondered how some people seem to make money while they sleep? Today I'm going to show you one of the simplest ways ordinary people build wealth without becoming stock market experts or spending hours researching investments. We're talking about index funds and how they can generate passive income for complete beginners. If you've never invested before, don't worry. I was exactly where you are now just a few years ago. I thought investing was only for rich people or financial geniuses. But here's what I discovered that changed everything for me. Let me start with a simple question. What if I told you that you could own tiny pieces of hundreds or even thousands of companies with just one purchase? That's essentially what an index fund is. Think of it like buying a basket that contains small portions of many different fruits, except these fruits are shares of companies. An index fund is a type of investment that tracks a specific group of stocks or bonds. The most common one tracks something called the S&P 500, which includes 500 of the largest companies in America. When you buy shares of an S&P 500 index fund, you're essentially buying a microscopic piece of companies like Apple, Microsoft, Amazon, and hundreds of others all at once. The beautiful thing about this approach is simplicity. Instead of trying to pick individual winning stocks, which even professional investors struggle with, you're betting on the overall growth of the entire market. Historically, this has been a smart bet. Now let's talk about the passive income part. Index funds generate income in two main ways. First, many of the companies in the fund pay dividends. These are quarterly cash payments that companies distribute to their shareholders. When you own shares of an index fund, you receive your proportional share of all those dividend payments. The second way you make money is through capital appreciation. This is a fancy term for the fund's value going up over time. As the companies in the index grow and become more valuable, your shares become more valuable too. Here's where it gets interesting for passive income seekers. Let's say you invest $10,000 in an index fund that pays a 3% annual dividend yield. That means you'd receive about $300 per year in dividend payments, or about $25 per month. That might not sound like much, but remember, this is completely passive money that requires zero effort from you. The real magic happens when you reinvest those dividends to buy more shares of the fund. This creates what's called compound growth. Your dividends buy more shares, which generate more dividends, which buy even more shares. Over time, this snowball effect can become incredibly powerful. Let me share a realistic example. Suppose you start by investing $500 per month into an index fund. Based on historical market returns, that fund might grow by about 7% annually on average. After 10 years of consistent investing, you could have around $87,000. At that point, if the fund pays 3% in dividends, you'd be receiving about $2,600 per year in passive income. But here's the key point that many beginners miss. This isn't a get-rich-quick scheme. Building meaningful passive income through index funds takes time and patience. The stock market goes up and down in the short term, sometimes dramatically. But over long periods, it has historically trended upward. One of the biggest advantages of index funds for beginners is that they're incredibly diversified. When you own an S&P 500 index fund, you're protected against any single company failing. If one company in the index goes bankrupt, it represents only a tiny fraction of your total investment. This diversification significantly reduces your risk compared to picking individual stocks. Index funds also have very low fees compared to actively managed funds. These fees, called expense ratios, typically range from just 0.03% to 0.23% per year. This might seem small, but over decades of investing, keeping fees low can save you tens of thousands of dollars. Getting started is surprisingly straightforward. You can open an investment account with most major brokerages in about 15 minutes online. Many platforms have no minimum investment requirements, so you can start with whatever amount you're comfortable with. You can find optional platforms beginners often use linked in the description. Once your account is set up, you simply search for an index fund, decide how much to invest, and place your order. Many brokerages offer automatic investing features, so you can set up monthly contributions that happen without any additional effort from you. However, I need to address some important considerations. First, all investing involves risk. The value of your index fund will fluctuate, and you could lose money, especially in the short term. Never invest money you might need within the next few years. Second, index fund dividends are typically taxed as ordinary income unless you hold them in tax-advantaged accounts like IRAs or 401ks. It's worth understanding the tax implications before you start investing significant amounts. Third, while index fund investing is simple, it's not exciting. You won't have dramatic success stories to share at parties. Your wealth will likely grow slowly and steadily over many years. For some people, this boring approach is actually perfect. The key to success with index fund investing is consistency and patience. Set up automatic monthly investments if possible, and try not to check your account balance too frequently. Market volatility can be emotionally challenging, especially for new investors. Start small if you're nervous. Even investing $50 per month is better than not investing at all. As you become more comfortable and see how the process works, you can gradually increase your contributions. Remember, the best time to start investing was 20 years ago. The second best time is today. Index funds offer one of the most accessible paths to building long-term wealth and generating passive income, even for complete beginners.